inspirational and motivational here at Clubhouse. Get a better mindset and set your goals here at Clubhouse. Educational things you need to know here at Clubhouse. Like credit, home, buying loans, and much more here at Clubhouse. The space for education, motivation, and inspiration. Clubhouse. The space for education, motivation, and inspiration. Clubhouse.
Goodness. Jessica came in. Hold on. Hey, everybody. How y'all doing? Welcome to the Home Buyers Clubhouse, where we go live every Wednesday and every Friday. On Wednesdays, we get something inspirational and motivational, and on Fridays, we give you something educational. Hello, Facebook user. Happy Friday to you. Welcome, y'all. Welcome. Come on in. Have a seat. Welcome to the Home Buyers Clubhouse. I think I'm live on TikTok as well, but I can't figure out how to get back to my screen because I got a new phone. So y'all gotta excuse me. I think I'm there. Yes. So if y'all want to send me an invite on TikTok, come on in. Hey y'all. So look, today we are talking about creative financing. My friend, she called me the other day. She's thinking about buying a house from another one of her friends or whatever, right? But the issue is she basically she just started a new job. She started a new job or whatever, and she's like an independent contractor. So she kind of already know, look, I can't get pre-approved the traditional way. So, her first question was, can she assume her friend's loan? That's the first question or whatever. Erica, somebody say, peace goddess. So, so the first question was, can she assume her friend's loan? Erica, as a lender, and what would you do or what would you say in the situation if somebody called you and talked to you about it? I know what I told her, but what would you say in this situation?
I would say in some cases it's possible to assume the loan, but in most cases, when you're looking at assuming a loan, you have to be able to pay whatever the difference is between the loan amount and the amount that they're asking for the property.
Yes. So I was also explaining to her, because like I said, her situation is she knows she can't get approved. So, and the lender, they're going to require that they get approved, correct, as well. Her DTI, they're going to do a credit check and all of that, right?
Right.
Okay. So those are some of the issues when it comes. I was telling her also she want to go and she want to check to see if the loan is actually assumable. And what does that mean when they say assumable? What's an assumable loan?
That means that the lender will allow you, as long as you qualify, then they will allow you to take over that loan with the same terms, the same interest rate that the original person had left. So if they've paid on that loan for 5 years and they had a 2% interest rate, then you can assume the balance that they have on the loan plus that 2% interest rate.
Okay, so let's talk about that, because that is very beneficial right now in this market because
interest rates are definitely higher, and a lot of people were able to refinance or buy a home within the last couple of years at a 2 to 3% interest rate, whereas interest rates right now are like 7 and above is what you're looking at for an interest rate right now.
Yes. So Nicole, do you get those calls a lot about assumable loans and assuming taking over their friend's mortgage?
I've gotten a few, but I don't think a lot of people that are shopping in this market are aware of the assumptions. So that's a great conversation to have, because many people that may be in a position to be able to do so don't realize that that is an option.
Right. Yeah. And right now these rates are crazy. So her friend could have like a 2%. And right now what the rates are, what are the rates right now? They still at 6%?
They are in the 6s and 7s right now. Is what they're looking at right now. Depending on the loan type that you're getting.
Okay. So, all right. So let's talk about that also. So certain loans, and I was also telling her that if it's a conventional loan, most conventional loans are not assumable. So that's why it's important for her to read. But most of the time, if it's like a VA loan or a government backed loan, a FHA loan, or something like that, they're normally almost always assumable, right?
Right. A lot of cases they are assumable. But like I said, the biggest hurdle for most people is you have to come up with the difference between the loan amount and the asking price amount. So even though I might only owe $100,000 on this house that I bought 5 years ago, I might currently be asking $150,000. So that means you're going to have to come up with that extra $50,000 plus then assume the loan for the $100,000.
Right. So, and that's what I was telling her. Also, I was telling her what she could do is see if the lender is willing, but she can't do that because she's in her situation. But if she wasn't, see if the lender is willing to finance that for her as well. Or is your friend selling the house for just for the loan amount, or is she selling it for the equity that she has in the property as well? And for the people who don't know what equity is, explain to them what is equity.
Nicole, you want to take that one?
Y'all have to excuse me if y'all can hear the noise in the background. So your equity in the home is the difference between, can you hear me?
Yeah, we can hear you. You good, girl?
Okay. So that is the difference between what you owe and what your house is currently able to sell for. So if I owe 100,000 and I sold my house for 150, that 50,000, my house is worth 150,000. My house, that 50,000 is your equity in your home.
There you have it. All right. So if you decide to assume a loan, your friends or whoever, this is one way that you could do it. So the first thing you want to do is you want to contact the lender, and you also want to review their statement. Their mortgage to see, okay, can you assume this loan? Number one. What type of loan? If it's an FHA loan, the FHA may require that you still pay that 3.5% down, although you are taking over this loan. Number two is you want to calculate how much money you need to pay up front. Like Erica said earlier, the equity in a home, you may have to take out a loan or you may have to come out of pocket. And I was telling her she may have to just pay a large down payment as well.
So wait, Jessie, before you go too far, I do want to let people know the seller actually has to find out whether their loan is assumable or not. So before they, whoever's selling the house is who would find out whether that loan is assumable, because they're not going to give a potential buyer information about your loan.
Yeah. So that's why that was number one. They need to review the documents to see if it's assumable.
Right. So I wanted to make sure that they realize that the seller has to do that. The buyer is not the person to review the documents.
Yes, that's good. I like that. Will the bar allow, where was I? Okay. Will the lender allow you to borrow the difference? Then you need to get pre-approved. We talk about this all the time on here. You got to get pre-approved the traditional way. A lot of people call me. I've had these calls a lot, to be honest. Can I take over my mother's loan? Can I take over my father's loan? But you still have to get pre-approved the traditional way. They're gonna have to run your credit. They're gonna have to verify your income, verify with the job if you're gonna take over somebody else's loan. So number two is same thing. We just talked about your down payment and your closing fees, and then you go to closing and you sign all documents, and then the property is yours. So now let's rewind, because I told you that my friend, her situation is she's an independent contractor, and this is what I suggested to her because she can't get approved the traditional way. And a lot of people don't think about this whenever they are structuring a loan, if they don't have enough money for certain things, not closing costs, but certain things throughout the process. I said, do seller financing. See if the seller will do seller financing in this situation. And she didn't understand exactly how that worked. But what happens with seller financing is it's normally for people who have a low credit score, who can't get approved the traditional way. So you should talk to them about seller financing. And sometimes what seller financing is, you may have to pay a larger down payment up front. Like I said, your friends, maybe a big the equity, or her friend needed like to pay like 5% down on her other house that she's getting. You may want to see if you can give her that as a down payment. So it's different ways that you can structure the seller's financing. There are pros and cons to it, but there are different ways that you could do it. And the cons are, some of the cons to seller financing is just basically you may have to pay a higher interest rate. But I've seen some sellers, they are willing to do no interest. It's all about how you negotiate. And if you want to bring your realtor or someone in that situation, they may do no interest. But in the end, okay, let's say if they do seller financing and then a few years later, they want the full payment up front. Because she was getting that confused with the lease with the option to purchase program. And y'all know what that is. One of y'all want to explain that to her also. Well, to them, what's the lease with the option to purchase program?
So it's basically almost like a rent-to-own type of program where there are certain companies which will purchase that house for you, and then you pay them a certain amount, and they take part of those payments and then credit those towards the purchase of that house within a certain time frame. Some places I've seen it's been 2 years. Some places it's been up to 5 years.
Yeah. And it depends on whoever's doing the program, because, certain states, which is, like I said, 3 to 5 years, 2 to 5 years. So it's different things. So that's at least with the option to purchase. But with seller financing, that's different. Seller financing, if you and this seller decide that you want them to finance this house for the next 30 years, y'all can do that. The seller is your bank. So whatever you guys agree on, that's what y'all can do. But if y'all say, I'll finance this house to you for the first 5 years or the first 10 years or the first 20 years, and then you got to pay like a large balloon payment at the end, that's up to you and that seller, and y'all can negotiate it. Y'all want to come in, anybody? Because y'all just quiet.
Well, that's great information.
I was going to say, one of the things that I found on seller financing. Yeah.
You good?
Typically, the ones that I've dealt with on seller financing, the interest rates they usually charge a little bit more interest if they are charging interest, because they're assuming the biggest risk. So, and the down payments are usually a little larger. Someone that I have that I'm walking through the process right now, their down payment was about 40 grand. And so, and the seller wanted about, the interest rate is not bad, but they wanted about 6%, 6.5%. And so, that part of it, and making sure that that your house is not, while you're making those payments, making sure everything is lined up to make sure payments are being made to the mortgage company, and that later on we don't have to worry about anything else coming up.
And Erica, that was my question for you. So I know when I rewind and I first learned about like creative financing and all this other stuff, there was a suggestion, if they don't have enough money for closing costs or a down payment, was a down payment, certain things that you could basically take that money, the seller could finance it, and then you have your mortgage on this side. How would the lender handle that on their end? Or is there anything that y'all do, or that my client should have to worry about besides the attorney handling the seller financing paperwork?
No, because most of the time, if a seller is financing it, then they are your lender. So
no, because I think it's a situation as far as the DTI. So like, if you give them a mortgage for $200,000 and they are short about, let's say, $5,000 or something like that, how would you guys do that whenever it comes into their DTI, if the seller decide to do like maybe about $5,000 financing or something like that?
So they can either issue seller credits for that $5,000. So that sometimes is an option. Or, you may be able to look at some sort of lender credits or like seller gifts. So, any of those are options to make up that $5,000.
No. So I think you're misunderstanding what I'm asking.
Okay.
Nicole, do you get what I'm asking? Because sometimes I'll be asking questions, right? So let's say if they decided, go on. If they decided to do,
No, I think what you're basically answering you. Yeah.
what'd you say, Nicole?
It,
She froze.
I think she has a delay, so she doesn't hear the questions in real time. So someone said when you do seller financing and close on the home,
trying to allow if we're allowed to do it the way you're asking. So if the buyer is short $5,000, I think what I'm hearing Jesse say is, can the seller finance that $5,000 for the buyer?
Boom. That's the question.
No. So usually that's because then you can do gift funds, but so that would be really the only way to do that. So your seller can't then go in and say, well, I'm going to give you this $5,000 unless it is a gift. Because that constitutes basically a gift or taking out an additional mortgage on the loan. And so most of the time, that's one of the questions that they ask is, will you do any additional financing for this particular piece of the property? Because usually your lender wants to make sure that they are in the first position.
So what's this question? When you do seller financing and close on the home, then try to flip to a traditional loan with the lender, most times except VA loans, the max loan amount is 80% of the home value.
Yes, that is actually that's Mr. Alfred. That's another lender. So so what he's talking about is most of the time when you're trying to do basically kind of a cash out refinancing, you're limited to 80% loan to value.
Okay. I think I'm so confused right now because we delayed and we answered like 12 different questions and I don't know what's going on this end. I'm just like, did we ask a question about that? So yeah, I think we got some delays. Thank you, Jaren. That was Jaren, right?
Yes. Mm-hmm.
Yes, thank you, Jaren. I appreciate you as always. All right. So no, I was asking because I think I heard something about the DTI. If the seller decides to do some kind of seller financing on the other end, it's still going to go into the DTI. So if the buyer ended up paying about $50 per month in the $50 paying the seller's $50 per month, that's going to go into their DTI as well. And that's why we have to disclose it to the lender because it may affect that. So
that is possible. So
yeah,
so now I know what you're saying. So so it's just basically like they're taking out a loan from the seller for this $5,000, and then we do have to add that in as a payment, a financial obligation payment with your debt to income ratio.
There we go. Sorry, y'all. We were having some technical difficulties over here. It was like you were talking and Nicole would come in and start talking, and I saw this pop up over here, and I was just confused. But anyway, all right. So we back to that. So all right. So back to what we were saying. We were talking about seller financing, the pros and cons of seller financing. You can close faster. That's one good thing of seller financing. Is less closing costs. Some of the cons are your balloon payments. Several years from now, you may have to pay a large amount. That's up between you and the seller, whatever you guys decide on. Your higher interest rates and your large down payments. And that's it. So I think that's a good way for my friend to go is seller financing because her income is she's just started a new job or whatever. She's independent contractor, and that's the way to go, especially if you're self-employed. So let's rewind and kind of go back to these other loans that we are always talking about. So explain to them, because we said a conventional loan is you cannot, a lot of the times, we didn't say always, but sometimes you cannot do an assumption on that. So let's talk about that. So with a conventional loan, and we talk about this a lot, tell them what's the minimum credit score with a conventional loan?
That's usually going to be a 620. Again, now your criteria is different depending on what financial institution that you go through, or some places is 640, but the baseline is generally 620 for that.
So let's talk about this. We talked about I saw a post in the group about the loan amount changing, the maximum loan amount. Is that what the post was about?
I did. Mm-hmm.
What's that about?
So the maximum loan amount you can do for a conventional financing is increasing for January. And so that's what that's going to be.
And that's like 700,000?
Yes.
Shoot, I know my sheet is old. The sheet, I said sheet, y'all. I said sheet. This sheet is old. Because this thing, because like I said, you just released that a few days ago. This sheet says 484, 350.
So it hasn't been that for the past couple of years because it goes up every year. They look at the average house pricing, and then they will raise the loan limit for a conventional financing loan. So anything above that amount, which is the I think it's 743 right now. So anything above that amount is considered a jumbo loan, and your interest rates and the rules change once you get above a certain amount.
Thank you, Jaren. We know who you are now because on my end, all I see is Facebook user. So thank you so much. All right, so let's talk about this. So if somebody that has like a foreclosure or a short sale, can they get a conventional loan?
They can in certain cases. So sometimes it has to be a certain time frame since you've had those things that have happened, but it is still possible.
Okay, now Nicole, you are a short sale specialist. What's a short sale and what's a foreclosure for those who don't know?
So sorry, I got bad delay on this. Is basically where we're selling the house short of what we owe. So if you owe the bank 100,000, but if we were going to place it on the market and it's only worth about 80,000, that leaves a deficiency in your loan. So that's what would be when you're in a short sale situation. Now your foreclosure is when the bank has actually taken possession of the house back, meaning they now own your house again.
But you can get a house. My throat is dry. You can't get a house after foreclosure, right?
You can get a house after foreclosure. Absolutely. So your rules are, again, they're going to be a little bit different for each loan type, but it is possible.
What about bankruptcy, Chapter 7 bankruptcy? How long after a Chapter 7 bankruptcy can you get a house for a conventional loan?
A conventional loan is going to be 4 years after a Chapter 7.
And what about someone that filed Chapter 13? Can they get a home and how long?
They can. Again, so it depends on the loan type. So it's anywhere from 12 months to 2 years. So with like a government-backed loan, like an FHA, VA, is usually going to be 12 months from the filing date. And your Chapter 13 on a conventional is usually going to be 2 years from the discharge date.
Okay, so earlier we mentioned a government-backed loan. Explain to them what's a government-backed loan and the credit requirements as far as that.
That's going to be your FHA, your VA, your USDA are all government-backed loans. And your credit is different depending on those type of loans. Your USDA and your FHA is usually 580. Your VA technically has no credit limit with that. It has no credit score requirement for a VA loan, but most lenders are going to require anywhere from a 500 to a 580.
Yeah. And so as far as the maximum loan amount, does that apply to that as well?
It does apply to that as well. Not VA loans. VA, there's no maximum. You can get $1 million loan with a VA as long as so your income can support it.
Oh, okay. Okay. So what about foreclosures and short sales and bankruptcies? How do they work with the government-backed loans? So can you get a house with a short sale and a foreclosure on the government-backed loan?
A foreclosure you can. Short sales are generally in lieu of a foreclosure. So normally there's not a foreclosure if you're doing a short sale. So you're doing that to prevent foreclosure. But you're for a regular foreclosure, you're looking at a VA is 2 years. The rest of the governments are 3 years. So your FHA and USDA are 3 years. And usually on a conventional financing, it has to be 7 years.
Okay. And let's talk about Chapter 7 bankruptcy for your FHA and your VA. How long do they have to wait?
Chapter 7 is going to be for conventional is...
No, FHA.
Oh, for FHA, VA, and USDA. So FHA and VA are 2 years from your discharge date, and USDA is going to be 3 years from your discharge date.
Yeah, so I see, and you mentioned this earlier about the Chapter 13 for your FHA. That's 2 years, and VA
Mhm.
and USDA is none. Is that right?
It's 12 months.
Okay, awesome.
And so there are a few other criteria that you have to meet for like a Chapter 13. You can't have any late bankruptcy payments. And if you're still under bankruptcy, you have to get permission from the court.
Awesome. So, audience, do y'all have any questions? Because we talked about getting a loan assumption, and that's what you're doing. With that is you're basically taking over someone else's mortgage. And then we talked about seller financing, and basically the seller is your bank, and y'all come up with whatever terms y'all need to come up with. Okay. And then we just talked about the different loan types, and those are the traditional loan types that you do. You go into your bank and you borrow money. Do y'all have any questions about that? TikTok, Facebook, do y'all have any questions about the different loan types? And Nicole and Erica, do y'all have anything y'all want to add?
I will say that you don't always have to go to your bank, because I know we generally say bank, but there are other places like, so I'm a direct lender, so we loan you our own money, but we're not bank affiliated. So that is always an option for you. And usually our requirements are going to be a little bit less strict than a bank, because we don't have those investors to that we have to answer to. So
Jaron and Erica said, clear that up real quick. we need to clear that up. Oh no, you're gonna stop saying bank, Jesse, because let's be clear.
Yes, right. This ain't what this is.
Well, y'all knew what I meant. Y'all funding money. The sellers, y'all knew what I meant, dog. But I'm glad you cleared it up. Because some people, they will be confused about it. Y'all got anything else y'all want to add? TikTok, y'all have any questions out there? Nicole, you got anything? How's the market? How your clients looking right now? Do we need creative financing right now? Do we need to take over any loans? Do we need seller financing?
Right now, I think everybody that's really serious about buying is in a good place to buy. We're still finding some areas where we still doing the most all certain houses, but I think those that are out here that are serious are really, really taking the time to take this opportunity to, as the prices level out. I will not say drop, because I keep hearing people say that. They are leveling out. As they level out, a lot of people are taking the opportunity to get in before we hit our spring market next year and we get back to having a bunch of players in the market.
Yes, and it is. So yeah. Now look, y'all, now is the time to buy. I'm telling you, now is the time to buy. The rates are higher right now, so it's a little discouraging when you see those payments. But I'm telling you, you can always refinance when those rates drop lower. That's all I'm saying. And you'll have your house, and you won't have to bid $100,000 over asking price, and you won't have to come out of pocket another $50,000 for your due diligence and your earnest money and all that stuff.
For the most part,
your first child.
For the most part, it's actually cheaper to buy a house now than it was in the spring. So even though housing prices were a little bit higher then, and your interest rate was lower, you're thinking over 30 years of financing that house, as opposed to what's your monthly mortgage payment. But if that house has dropped $50,000, even though the interest rate is 7%, a lot of times you're still coming out better doing it this way than you are paying an extra $50,000 for a house. Because now those people their houses are not worth what they paid for it.
So is it better to rent right now, or because I think rental prices, they're not decreasing at all.
They're not.
It's getting easier to buy a house.
They're absolutely not.
Well, because you got more people, a lot of people
is not going down for us.
Right. The institutional investors, they bought up a lot of these houses and they are charging market rate for them.
So look, y'all, for those of you guys who's thinking about buying a house next year or in the next 6 months or 3 months or next month, who knows? We have a book. It's called The Home and Credit Recipe. In this book, Nicole, you want to talk about it, girl? She's like, Jesse, I'm delayed.
Well, look, I can't talk today. The Home and Credit Recipe Journal is one of those. It's a tool that you can use to get your home buying process. It has everything you need from A to Z in this book on how to purchase your home, and not just purchase your home, but if you're looking to get your credit straight, you're looking for how do I write a dispute letter, everything that you could possibly need to do it is in there.
Look, y'all, and this weekend I'm actually thinking about sitting down. I might do a TikTok or something or go live, I don't know, and actually going through this book. Because we were talking about doing a vision board party this weekend, and we still would like to do a vision board party if we get some people to come. But if we can't, I've been thinking about, going on TikTok or whatever to just kind of sit down and talk about the goals in here and just talk about, set up your vision board and do your habit tracker. And here you have your spiritual tracker, your financial goals. It's all about your vision. Set up your vision for yourself. A lot of people, we want so many things in life. And sometimes we could actually manifest those things just by writing them down or just speaking them or creating a vision board and putting them in front of us. So yeah, it's like Nicole said, it's so much in this book. You have a habit tracker, your credit tracker, you check your credit each month, you checking your savings each month. We have a savings tracker. Everything is in this book, y'all. And I'm telling you, it's in here if y'all need to do it. It's all about mindset. It's about home ownership, building your credit. All of that is in here. One-stop shop. And look, that's your journal right there. All right. Sorry. All right. That's anything else? TikTok, y'all have any questions for us? No questions? None? Nada? All right. All right, y'all. Facebook, if y'all don't have any questions for us, we're logging out. For those of you guys who don't know me, my name is Jessie Lynn. I'm a triangle realtor with A to Z Realty. You can reach me at 919-818-9854. Miss Nicole. She froze.
I'm Nicole Crawford. I'm a realtor with Keller Williams Realty, servicing the Greensboro Triad area. And I can always be reached on my cell, which is 336-457-3007.
Look at this little girl at the bottom. She looked like a little girl today. I don't know if it's because she looks short. She like her face is slimmer. I don't know what it is. So she is glowing on that girl. Tell them how they can reach you, honey.
I am Erica Batts. I'm your mortgage loan officer. You can reach me at 919-608-7916, or you can always reach me at ericabatts.com.
And y'all can reach us in the clubhouse at www.thehomebuyersclubhouse.com. You can find us on Facebook, on our page, and in our private group at Home Buyers Clubhouse. You can find us on YouTube at The Home Buyers Clubhouse. We guys hope you have an awesome day. You have a safe weekend. You have a Merry Christmas. You have a Happy New Year. And you have a Happy Hanukkah and all the great holidays in the world. TTY, come back to see us.
Bye.
Yes, bye.